Ethan buys a rental property. Noah puts the exact same amount of money into index funds. Both of them think they made the smarter decision. And both of them are only seeing half of the truth. Because Ethan forgets to count the hours. Noah forgets to count the zeros. And when you actually run the numbers over 20 years, the difference between what people think is happening and what is really happening can make your stomach drop. So let's make this fair. No perfect examples. No fantasy returns. No lukitimin. No nightmare scenarios designed to make one side look stupid. Just two regular people, starting from the same financial position, making two different decisions. Ethan and Noah both have $50,000 saved. They both earn $55,000 a year. They are the same age. They live in the same city. They have the same starting point. The only difference is what they decide to do with that $50,000. Ethan looks at the money and sees a down payment. Noah looks at the money and sees a portfolio. Ethan wants an asset he can touch. Noah wants an asset he does not have to manage. Ethan wants rent checks. Noah wants compound growth. Ethan wants leverage. Noah wants simplicity. And from the outside, Ethan looks like the one making the bigger move. He uses the $50,000 as a 20% down payment on a $250,000 rental property. It is a modest 3-bedroom house in a decent neighborhood. Nothing fancy, nothing luxury, just a normal rental property. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,330. Then he finds a tenant willing to pay $1,800 a month in rent. On paper, the math looks amazing. $1,800 in rent minus $1,330 for the mortgage leaves $470 a month. That is $5,640 a year in positive cash flow. And that is before appreciation, before equity, before tax benefits, before anything else. Ethan feels like he has discovered a secret that most people never understand. He does not just own an investment. He owns a house. He has a tenant. He has someone else helping pay down his mortgage. And he has a story he can tell at dinner. Noah takes the same $50,000 and does something much less exciting. He puts it into a total stock market index fund. No tenants, no keys, no mortgage, no inspection report, no contractor phone numbers, no closing table, no property photos, just a brokerage account and a confirmation email. Then he sets up an automatic contribution of $300 per month. Every month, that money moves from his checking account into the index fund. He does not pick individual stocks. He does not try to predict the next big company. He does not watch financial news every morning. He just buys the market and moves on with his life. When his coworkers ask what he's investing in, he says, index funds. They nod politely. Then they change the subject. Nobody is impressed. Nobody asks him for advice. Nobody says he is building an empire. On day one, Ethan has a house, a tenant, and a real asset he can drive past. Noah has a number on a screen. Emotionally, it does not even feel close. Ethan feels like an investor. Noah feels like someone who filled out an online form. But feelings and math are two very different things. For the first few years, Ethan feels like he is living the landlord dream. The rent hits his account every month. Every payment feels like proof that he made the right decision. He drives past the property and thinks, that belongs to me. He tells himself the tenant is paying the mortgage. He is building equity every month. He gets to deduct mortgage interest. He gets depreciation benefits. He watches similar houses in the neighborhood go up in value. Everything about the investment feels real, tangible, and smart. And when people ask what he is doing with his money, he has a powerful answer. I bought a rental property. That sentence sounds serious. It sounds responsible. It sounds like wealth. Noah has a very different experience. He logs into his brokerage account once every few months. Sometimes the number is higher. Sometimes it is lower. Sometimes nothing interesting happens at all. In the first year, his $50,000 might grow to around $55,000. In the second year, maybe $61,000, but still does not feel dramatic. No one sends him rent. No property appreciates in a neighborhood he can drive through. No one asks him about his strategy. There is no social proof. There's just a number on a screen moving up and down. Ethan's friends ask him about the rental. Noah's friends barely ask him anything. And in the early years, that difference matters more than people admit. Ethan looks active. Noah looks passive. Ethan looks like he is building something. Noah looks like he is waiting. If you only judge the investments by how they feel, Ethan would appear to be winning by a landslide. But now we need to look underneath the surface. By the end of year 3, Ethan has collected roughly $64,800 in rent. $1,800 per month for 36 months. His mortgage payments over those same 3 years total roughly $47,880. That leaves $16,920 in gross cash flow. On a simple spreadsheet, that number looks great. But rental properties do not live on simple spreadsheets. Property taxes cost around $3,000 a year. That is $9,000 over 3 years. Insurance adds another $1,500 a year. That is another $4,500. Then the water heater goes out. $1,200. Then a roof leak appears after a storm. $2,800. Then one tenant moves out and the house sits empty for 1 month. That costs Ethan $1,800 in lost rent. Then another $600 for cleaning, touch-ups, and relisting. And because he wants to save money, he does not hire a property manager. He manages the property himself, which sounds free until you count the hours. Phone calls at 10 p.m., weekend showings, messages during work, coordinating plumbers during lunch breaks, screening tenants, answering complaints, following up on late rent. driving to the property when something feels wrong. That money did not leave his bank account as a management fee, but the time left his life. And time is not free just because you refuse to price it. After all the real expenses, Ethan's actual net cash flow over the first 3 years may only be around $2,000 to $4,000, not $16,920. And that still does not count a single hour of his time. This is the first trap in rental property math. People love counting the rent. They love counting the mortgage paid out. They love counting appreciation, but they forget the quiet leaks: vacancy, repairs, taxes, insurance, capital expenses, turnover, management, stress, and time. The $470 monthly cash flow number is not fake. It is just incomplete. And incomplete math is dangerous because it feels like truth. Meanwhile, Noah has done almost nothing. He invested the original $50,000. He added $300 a month. Over 3 years, that is $10,800 in extra contributions. If the market averages around 10% annually over that period, his portfolio might be worth about $76,000. He did not spend weekends fixing anything. He did not negotiate with tenants. He did not carry a mortgage. He did not get emergency texts. He did not learn the hard way that one small leak can become a very large invoice. But Ethan still has one powerful advantage: leverage. And this is where real estate becomes genuinely powerful. Ethan did not use $50,000 to buy $50,000 of assets. He used $50,000 to control a $250,000 property. That is the part stock investors often underestimate. If that property appreciates 3 to 4% per year, it could be worth around $270,000 to $280,000 after 3 years. That appreciation happens on the full property value, not just Ethan's down payment. So even if his cash flow is smaller than he expected, his equity can still grow in a meaningful way. His equity is the difference between what the house is worth and what he still owes. By year 3, depending on appreciation and mortgage paydown, Ethan's equity could be somewhere around $55,000 to $65,000. That is real wealth. And part of it exists because he used the bank's money. That is the magic of leverage. But it is also the danger of leverage. When prices rise, leverage makes you look brilliant. When prices fall, leverage reminds you who actually owns the risk. And that is why real estate conversations are so confusing. The real estate person is right that leverage can build wealth quickly. The index fund person is right that simplicity and diversification are powerful. The problem starts when either side pretend the other side has no point. By year 5, Ethan is no longer living in the fantasy version of being a landlord. He is living in the real version. He is on his 3rd tenant. He has replaced the roof for $8,500. He handled a plumbing emergency that cost $1,400. He had 1 full month of vacancy between tenants. He raised the rent to $1,950, which helps. But his property taxes also went up. His insurance went up. Materials got more expensive. Labor got more expensive. And every time he thinks the property is finally stable, another small problem appears. His real cash-on-cash return, after expenses, may be around 3 to 5%. That is not terrible. It is actually respectable. But it is not the 15 to 20% return he bragged about after doing quick math on a napkin. Noah, at this point, is still doing almost nothing. And that is exactly why people underestimate him. By year 7, assuming steady contributions and long-term market growth, his portfolio may have grown to somewhere around $135,000 to $150,000. Now the numbers are starting to matter. His gains are producing more gains. The money he earned is earning money of its own. His account is no longer growing only because he contributes $300 a month. It is growing because the portfolio itself is becoming productive. This is where compound growth starts to feel different. For the first few years, compounding is boring, almost disappointing. People talk about it like magic, but early on it just looks like slow progress. Then, over time, the curve begins to bend. Not dramatically at first, then more clearly, then suddenly. The strange thing about compounding is that most of the visible magic happens late. The early years build the base. The later years create the shock. That is why people who quit early never experience the part everyone talks about. By year 10, Ethan's property may be worth roughly $335,000 to $350,000. His remaining mortgage balance may be around $166,000. That puts his equity somewhere around $170,000 to $184,000. That is a serious result. He turned $50,000 into a much larger equity position. He used leverage. He collected rent. He gained tax benefits. He built wealth in a real, tangible asset. But he also spent much more than the original down payment. After repairs, taxes, insurance, vacancy, capital expenses, and occasional out-of-pocket costs, Ethan may have put an additional $20,000 to $35,000 into the property over 10 years. And he spent hundreds of hours managing it. Those hours matter. Real estate returns are not just financial returns. They are labor-adjusted returns. And if you ignore the labor, you are comparing two investments that are not actually comparable. Noah's portfolio by year 10 may be worth roughly $165,000 to $180,000. He invested $50,000 up front, plus $36,000 in monthly contributions. That is $86,000 of his own money. Everything else is growth. No tenants, no debt, no contractors, no roof replacement, no vacancy, no late night calls, No negotiations. No local market risk tied to one address. At year 10, they're surprisingly close. Ethan might be slightly ahead. No might be close behind. Depending on the exact market, either one could be leading. But the deeper difference is not just the balance. It is the experience. Ethan built wealth through control, leverage, and effort. Noah built wealth through patience, diversification, and consistency. Ethan had physical problems to solve. Noah had psychological problems to survive. And that brings us to the part people often miss. Index investing is simple. But simple does not mean easy. Noah did not have tenants calling him. But he had volatility. And volatility can be brutal. When a portfolio falls 30%, it does not feel theoretical. It feels personal. If Noah has $150,000 invested and the market drops to $95,000, that is not just a number on a screen. That is $55,000 of paper wealth disappearing. Even if history says the market may recover, his emotions do not care. His brain screams that he is losing everything. His coworkers talk about recession. Financial news becomes dramatic. Social media fills with fear. Everyone suddenly has an opinion, and the temptation to sell becomes very real. This is the hidden labor of stock investing. You do not fix toilets. You do not screen tenants. You do not replace roofs. But you do have to sit still while your net worth gets punched in the face. Many people think they can handle volatility until it actually happens. They think they're long-term investors until the market falls hard. Then they sell. Then they wait for things to feel safe. And by the time things feel safe, the recovery has already happened. That is how investors turn temporary losses into permanent ones. So Noah's path is not effortless. It is just a different kind of difficult. His challenge is not maintenance. It is behavior. His job is to keep buying when the market is scary. To not panic when his account drops. To not get greedy when everyone is making money. To not jump from strategy to strategy. To keep doing the boring thing long enough for the boring thing to become powerful. By year 20, the story becomes even more interesting. Ethan's property may be worth somewhere between $450,000 and $500,000. His mortgage is either paid off or close to being paid off. His equity may be somewhere around $400,000 to $500,000, depending on appreciation, mortgage balance, and market conditions. That is a huge achievement. He owns a valuable property. He has an asset that can produce rent. He has built wealth through forced savings, appreciation, leverage, and time. But the cash flow story is still more complicated than people expect. Over 20 years, he collected a lot of rent, but he also paid a lot of expenses. Taxes, insurance, repairs, maintenance, turnover, vacancy, major replacements, legal costs, possibly management fees, possibly renovations, possibly months when the property did not perform the way the spreadsheet promised. After all of that, his total net cash flow may be $40,000 to $80,000 more than what he spent. Maybe more in a hot market, maybe less in a flat market, maybe much less if he had a bad tenant, major repairs, or bought in the wrong neighborhood. His real wealth is mostly in the equity, the property value, the loan paydown, the appreciation, the leverage working over time. Noah's portfolio after 20 years, assuming a 10% average annual return and $300 per month in contributions, may be worth around $420,000 to $460,000. His total contributions were about $122,000, $50,000 up front, $72,000 over 20 years through monthly contributions. The rest is compound growth. No mortgage, no tenants, no single property, no one city, no neighborhood, no late night emergency calls, no roof, no fairness, no eviction. When you compare net worth, Ethan and Noah may end up in roughly the same category, somewhere around $400,000 to $500,000 each. But the way they got there is completely different. Ethan worked for his wealth. Noah waited for his. Ethan took on debt, concentration risk, illiquidity, and operational responsibility. Noah took on volatility, emotional pressure, and the need for long-term discipline. Ethan had control. Noah had freedom. Ethan had leverage. Noah had liquidity. Ethan had a visible asset. Noah had a diversified portfolio. Neither path is automatically better, but they're not the same path. And here is where the math changes dramatically. If Noah increases his monthly contribution from $300 to $500, just $200 more per month, his 20-year portfolio can jump to somewhere around $550,000 to $600,000. That small monthly difference becomes massive because of compounding. In the stock market, scaling up usually means increasing your automatic contribution. In real estate, scaling up usually means buying another property, taking on another mortgage, finding another tenant, and managing another set of problems. Different games, different skills, different stress. Now, if this sounds like an argument against real estate, it is not. Real estate can absolutely win, but it wins under specific conditions. It wins when the rent-to-price ratio is strong. If a property rents for close to 0.8 to 1% of the purchase price each month, the cash flow has a much better chance of working from day one. For a $250,000 property, that would mean rent closer to $2,000 to $2,500 per month. That changes everything. Real estate also wins when the buyer treats it like a business. That means budgeting for vacancy, maintenance, capital expenses, and tenant problems before they happen. It means tracking every dollar, knowing the local market, screening tenants carefully, and refusing to confuse gross rent with profit. Real estate can also win through house hacking. If Ethan lives in one unit and rents out the others, he can reduce his own housing cost while building equity at the same time. Noah's index fund cannot do that. Stocks can build wealth, but they cannot directly lower his rent or mortgage payment. Index funds are powerful, but they're not magic. They depend on long-term market growth. They require patience. They require emotional control. They require the investor to keep going when everything feels uncertain. They also do not usually create meaningful monthly income early on. A total market fund may pay dividends, but those dividends are often modest. A $150,000 portfolio might produce only a few $100s per month in dividends. That is not enough to replace a salary. And if Noah wants income, he may eventually need to sell shares, build a larger portfolio, or use a different withdrawal strategy. Stocks are liquid, which is usually an advantage. But liquidity can become a weakness when people use it emotionally. It is easy to sell. Too easy. Ethan cannot panic sell his rental property with one click during a bad news cycle. Noah can. That convenience is dangerous for undisciplined investors. So the real question is not, which investment is better? The real question is, which investment fits the investor? If you're disciplined, patient, and emotionally stable during volatility, index funds may be one of the cleanest wealth-building tools ever created. If you have steady income, can invest consistently, and do not need to impress anyone, the boring path can be incredibly effective. But if you have operational skill, understand local markets, can manage risk, and are willing to treat real estate like a serious business, rental property can be extremely powerful, especially with leverage, especially with tax advantages, especially with strong cash flow, especially if you can buy well. But if you buy real estate because someone online said tenants will pay your mortgage, you may be buying yourself a stressful second job. And if you buy index funds because someone said they always go up, you may panic the first time they crash. The danger is not the asset. The danger is misunderstanding the asset. Ethan thought real estate was passive income. It was not. It was active ownership with passive-looking deposits. Noah thought index funds were effortless. They were not. They required emotional discipline for decades. Ethan forgot to price his time. Noah almost forgot to respect volatility. Ethan counted the rent, but underestimated the repairs. Noah counted the average return, but had to survive the bad years. Ethan had an asset he could touch, but it demanded attention. Noah had an asset he could ignore, but only if he could control his emotions. And this is why the loudest investment advice is often the least useful. Real estate always wins. No, it does not. The stock market always wins. No, it does not. Rent checks are passive income. Not always. Index funds are risk-free. Absolutely not. Leverage makes you rich. It can. It can also ruin you. Compounding makes you rich. It can, but only if you stay invested long enough. The truth is much less exciting and much more useful. You have to run the full numbers. Not the numbers that make the investment look good. The full numbers. For real estate, that means purchase price, down payment, closing costs, mortgage, interest rate, taxes, insurance, maintenance, repairs, vacancy, capital expenses, management, legal risk, appreciation, rent growth, tax benefits, and your time. For index funds, that means starting balance, monthly contributions, expected return, volatility, taxes, fees, dividends, time horizon, withdrawal plan, and your behavior during crashes. Once you include everything, the question becomes clearer. Not easier, clearer. Ethan and Noah both made reasonable decisions. Neither one was stupid. Neither one was automatically right. They simply chose different machines. Ethan chose a machine that could build wealth through leverage, rent, tax benefits, and ownership, but required work, risk, and concentration. Noah chose a machine that could build wealth through diversification, compounding, and consistency, but required patience, emotional control, and time. And after 20 years, they may end up surprisingly close. But one of them spent those years managing an asset. The other spent those years managing himself. That is the real comparison. Not real estate versus stocks. Work versus patience. Control versus freedom. Leverage versus liquidity. Complexity versus simplicity. Visible progress versus invisible compounding. The best investors understand that both tools can work. They do not worship either one. They do not repeat slogans. They do not make decisions based on a viral clip, a podcast rant, or something a relative said over dinner. They run the numbers. They include the hidden costs. They understand the risks. They choose intentionally. And sometimes, the smartest answer is not Ethan or Noah. Sometimes, the smartest answer is both. Own productive real estate if the deal is actually good. Invest consistently in index funds. Use real estate for leverage and cash flow. Use index funds for diversification and liquidity. Build wealth from multiple directions. But do not confuse activity with progress. And do not confuse simplicity with weakness. Because the best investment is not the one that sounds smartest at dinner. It is the one you can understand, afford, manage, and stick with long enough for the math to work. So the next time someone tells you, real estate always beats stocks, ask them this. Did you include the repairs? Did you include vacancy? Did you include taxes? Did you include your time? Did you include the bad tenant? Did you include the roof? And the next time someone tells you index funds are always better, ask them this. Did you include market crashes? Did you include panic selling? Did you include the lack of cash flow? Did you include the discipline required to keep buying when everything is falling? Because the answer that includes everything is the only answer that matters. Ethan bought a house. Noah bought the market. Both built wealth. Both took risk. Both paid a price. The only real mistake would have been choosing without knowing what that price was.